With increasing concerns about municipal bond creditworthiness, we are pleased today to be able to ask Jim Spiotto of Chapman Strategic Advisors about his observations. This video is the first in a series. For most of his career, Jim Spiotto has been a partner of the venerable Chicago bond counsel firm Chapman and Cutler. He has specialized in corporate and municipal bankruptcies, and if anyone has more experience in bankruptcy law and bankruptcy proceedings than Jim, I would be very surprised. Let's start with the question, considering our subject, municipal bond credit stresses, bankruptcies, and worse. Jim, will you let our viewers know what could be worse than a bankruptcy?
Well, Paul, it's my pleasure to talk to you. And to start off on sort of the worst note, there are times in which you look at Detroit, you look at Stockton, you look at San Bernardino and Jefferson County, and you say to yourselves, how could this get worse? But if Detroit continued on to melt down and erode, we saw this in Bridgeport, Connecticut in 1991. They raised taxes. People, in reaction to the taxes, moved out. They had less money, which caused them to cut services and raise taxes. And services to the citizens eroded to such a degree that people really needed a solution. And the reason for Chapter 9 is to give the municipality a fresh start, to help them reduce their debt so that they are sustainable and affordable, hopefully to reinvest in the municipality and to reinvent the municipality in a direction that will stimulate business and create some opportunities. If you don't do that, and if you don't address it, and I think as we'll talk about today, staying tuned in early detection is very important. If you don't, municipalities don't come to abrupt stops. What happens with municipalities is they fade away. And as they fade away, people realize the services and the community environment that they wanted so much doesn't exist, and they have to move elsewhere.
Well, thank you, Jim. The next topic we'd like to touch on is for municipalities currently in financial distress. In general, can avoidable causes be identified?
Well, we know just looking at recent activities in the market, some of them, unaffordable, unsustainable personnel costs, where unfortunately promises may have been made to workers to pay them salaries or pension benefits that are not attainable, that there are not sufficient revenues in the municipality to pay for them. And yes, that is one of the causes, and can it be adjusted? Can it be stopped? Or should we say, in setting personnel costs and pensions, we must pay attention to what is our projected revenues, what is our projected revenue expenses, and what difference do we have to pay for those pension costs? If we don't have sufficient funds, we shouldn't promise that which we shouldn't pay. That's bad business, and it's also bad social policy. Deferred capital improvements in infrastructure. One of the sad things, whether it's Detroit to Central Falls, even Stockton, San Bernardino, and Jefferson County, would all testify that when you realize you have financial distress, you try to correct for it by cutting expenditures. And when you cut expenditures that are really necessary to keep your infrastructure at an acceptable level, you are not helping anyone, you are hurting your future. And so therefore, you need to keep on investing in the infrastructure that is acceptable, not only to attract business and new jobs for your citizens, which should be one of your goals as a municipality or a state, but also because the cost of doing it later, deferring it too long, is a greater cost and a greater burden then for your taxpayers. The decline of the urban area, which is really the fallout of unattainable, unsustainable, unaffordable costs and deferred capital expenditures, you wind up with urban decline. And we have to say, just like we know in our own lives, if things are not being maintained in our home or in our community, we should be there to make sure that they are maintained. And you can't tolerate any type of blight or any type of erosion of the quality of life in your community because it can be contagious. Very important. The Proposition 13 mentality. Yes, we want to keep taxes to a reasonable level. But if we cut tax revenues below that which is sufficient to support municipalities to the level that citizens want, you're dooming your future. So that is something to be avoided. Lingering legal issues. We saw in Mammoth Lakes in Boise County, Idaho, that both filed, they had a housing dispute with a developer that led to a lawsuit that led to a judgment that was bigger than what they could pay. We don't want lingering legal issues. We don't want surprise court decisions. We want to address them and get them resolved. The one issue that people are asking about, because we've seen sort of an increase in people questioning whether or not they have to pay bonded debt, and the willingness to pay versus the inability to pay. We all can understand the inability to pay, and we hope we never suffer it ourselves, but it's possible any of us can go through it. Every municipality tries to avoid it. When they're there, they need a helping hand. They need someone to help them turn it around, recover, and ultimately pay which they can pay. Willingness to pay is never understood. We started our country with a proposition that George Washington and Alexander Hamilton believed in, that public debt was supposed to be immortal. We were always supposed to dedicate a source of payment to every debt we incurred. After the Revolutionary War, it was George Washington and Alexander Hamilton that mandated that we must make sure that the revolutionary debt was paid. And when some of the states didn't want to do it for reasons that actually sound quite similar to today, some speculators in New York City had bought up the debt in London and were going to bought it at a discount and they'd make a profit. And they didn't want their hard-fought tax dollars going to pay for unwarranted taxes for speculators in New York City. Sounds a little bit like some of the arguments they were using in Detroit. And quite candidly, what George Washington and Alexander Hamilton said, we must do it because our progress as a country going forward will be no swifter than our progress in paying our debts and having credibility in the market. And with that tradition, we must solve the problem of a willingness to pay and say that should never be the issue. Inability is a problem which we have to recover out of.
Thanks, Jim. You have spoken of financial distress and you've mentioned urban decline. Would you select one or two or three factors that are the most important ones in preventing municipal defaults and bankruptcies that are the ultimate result of financial distress and urban decline?
Well, I think, and we have to look at what we are financing. First of all, anything that isn't an essential governmental service or serves an essential governmental purpose, we have to ask ourselves, is this something that a government, state or local, should be involved in? And does it have the life to make sure and the feasibility to really pay that debt? Because if we look back on obligations that have become problems, when we have strayed from essential governmental services into more speculative activities, whether they were the railroad bonds in the 1800s, where because people wanted to attract a railroad to their community, they built a train station or they put in other facilities to attract them, only to find that the railroad never came. And they tried to then repudiate the indebtedness, only to find that the U.S. Supreme Court said, you promised it, you borrowed it, you have to pay it. And so that's when we get into trouble. So first of all, we want to stick to our knitting in government finance and fund that stuff which is essential and not that which is a luxury. Second, we want to look, if it's a revenue bond, that the enterprise has the feasibility to pay it, that there would be a rate structure and customers that will pay the rates sufficient to pay off not only the debt and the debt service, but the operating expenses and maintenance and capital expenditures, being able to make sure that in the future you can make the improvements necessary to do it. With regard to general obligation or unsecured debt that you see, you want to make sure that the taxing ability and the demographics and the ability to raise taxes are such that the debt is not a bridge too far. And when you take all that into consideration, the feasibility, the creditworthiness, and the essential nature of the purposes, you could avoid most defaults.
Thanks, Jim. You mentioned general obligation debt. Is there any credit factor more important in relation to tax-supported debt or GO debt than the quality of the tax base?
Well, that certainly is the source of payment. And one of the key things to realize whenever you're making an investment is, how do I get paid back? And if I don't get paid back, what are my rights and remedies, and what are the rights or alternatives of the borrower? So you want to look at, one, can the borrower file for bankruptcy? We know very few states authorize Chapter 9 for municipalities, only 12 generally. Another 12 you need to get some approval from a state agency or state government official. So that's it. That's one. Second is the source of payment. And with the source of payment, you want to look at a couple of things. One, what are the tax limits and what are the debt caps? Because most states, virtually all of them, provide for the ability to refund debt. But if you're at your debt cap, you won't be able to do it, or you may not be able to do it. Sometimes they allow refundings not to be, have to be within the debt limit. The tax limits, the ability to tax and the limits on those, how close are they? Those are all important factors. And then, as we mentioned before, with regard to the source of payment, is it a tax source, be it a fee, be it a charge, be it a revenue source that is sufficient to pay? And long-term be there, i.e. that it can support itself and it's not subject to economic conditions that can reduce or eliminate that ability of taxes. And finally, you want to make sure that the people you are dealing with, and that's why credibility in the market has been so important to state and local governments, that when they say they will pay, they will pay. They won't question whether or not it was a valid and binding obligation, because their word is their bond, so to speak. And so therefore, if they promise to pay you, they will, and they will not contest it later on.
Jim, you referred to the causes of bond credit distress. In your opinion, are those causes generally revenue related or expense related or both?
Paul, for the most part, revenues and funds and cash is king. It's the most important thing for governmental bodies, and the sufficiency of it. While certainly on the expense side, you want to make sure that there is no waste, no unnecessary costs creep in, that you are efficient in your operation, and you don't expand beyond in services and in costs beyond your ability to pay. So those are all important factors. But as I tell people, municipalities in distress are a little bit like myself. I'm not overweight, I'm just too short for my weight. And they need more revenue. And to the degree they can generate more revenue, it is the lifeblood for the municipality, its ability to do its mandated purpose, and that is to provide essential services to its citizens at an acceptable level with the infrastructure that is acceptable to them. And if you do that, you will attract business, you'll stimulate your economy, you'll create new jobs, especially for your young people. That creates the new taxpayers, that has the revenue that keeps and helps a municipality not only sustain itself, but thrive.
Well, so that this discussion will not be totally bleak in terms of credit distress, from your perspective in dealing with current municipal credit disasters and historical credit disasters over the years, are you seeing today any positive developments?
Well, I think that we've had some sort of socially redeeming circumstances, i.e. Detroit, which is obviously a very serious and somewhat unfortunate situation for the people of Detroit, the problems of Jefferson County, Stockton, and San Bernardino and others have been a wake-up call for everyone to say, let's take a look and take an assessment of where we stand. And when we look at where we are, we say to ourselves, I want to prevent an erosion, I want to prevent a meltdown, I want to prevent a lack of services to my citizens, as I have seen has occurred in some of these circumstances. And I think that has allowed us in a number of fronts with regard to pension obligations, whether it's the city of Chicago and their effort both for general workers, for laborers, and now their efforts with police and fire to get voluntary adjustments and rollbacks in a way that will be helpful to the city and long-term helpful to the workers and the taxpayers, because it will help the city grow and expand. In San Jose, they tried to do that with Mayor Reed, and obviously they took a referendum. 70% of the people wanted the adjustment. However, when they took it to court after making the adjustments and the pension reform, the judge struck down the pension reform, but allowed the poison pill, which basically said it was within the power of the government. They couldn't change the bargain in one sense, but it was in the power of the government to cut salaries of employees 4% a year for the next 4 years in order to be sustainable and affordable. And hopefully that will bring about a resolution. 40 states have addressed pension reform since 2010, and actually over 40, and that has helped. Not only pension, I think we're starting to recognize something that is extremely important, and that is we need to reinvest in our infrastructure. We've had 11 economic downturns since 1949. The last one in 2008 has been the first economic downturn that we have not done what we've done in the rest of the other 10. And that is, we have not stimulated our economy by increasing state and local government borrowing and investment in infrastructure that has stimulated the economy, increased the employment, and ultimately contributed to the recovery by year-to-year growth both in GDP and in employment. As you know from the studies that were done both during the Depression and even recent studies, a dollar spent in hard infrastructure improvement to a municipality over the next 20 years brings back over $3 of economic benefit. It's that kind of return that we need. And so when we look at that, we look at early detection, addressing the unemployment problem by stimulating the economy, by building infrastructure, and addressing sort of the difficulty of unsustainable, unaffordable costs. In doing all that, I think our municipalities are going to make things better. If we fall back and don't pay attention to those things, then we won't achieve, as we have in the past, which is the world's best economy in the United States, still is, and the world's best infrastructure. One interesting point, we always hear people wanting to talk about how we are falling behind vis-a-vis China. China, just in rough numbers, their local governments, not the central government, their local governments in their borrowings in relationship to their GDP, their economic output, has a ratio of twice the debt to GDP as our state and local governments have debt to GDP. And they need to spend a lot more on their developing infrastructure and society. And so therefore, now is a time for us to realize our strengths and our economic prowess and develop our business and expand, which is the way we increase revenue and we make sure that the municipal market is strong.
Well, thank you for your positive comments. And for all of us that have found this session of Jim Spiotto's comments valuable, stay tuned for part 2.